Good morning, everybody. I'm Peter Marion, VP with JLL's agency leasing team, and you're going to have to be stuck listening to me for the next little bit as I continue the theme of the Tale of Two Cities. We're going to have a conversation with a diverse group of panelists representing more of the what we call the client side. And to that note, I'd like to introduce them right now. Come on up, guys.
I think they want me there.
In the Denver market. And from Boulder down all the way to the tech center, Unico has been on a tear in the past few years. They've got 50 properties totaling over 3.5 million square feet. Most recently, I know you guys announced the Platt Street project, so an exciting new development coming here in the downtown Denver market. Adam Hazlett, kind of in the middle of the pack there, is Director of Investments for Cortland Partners. Cortland is a full-service multifamily firm that's headquartered out of Atlanta. Locally here in Denver, Adam is in charge with running their investments for both Denver and just the Western U.S. in general. Previously, you spent time with Sage Hospitality and Schnitzer West. Welcome. Chris Terrell, just second one in, has led Home Advisor as their CEO since 2011. For those of you who don't know, Home Advisor is the largest online marketplace for home improvements, and they're headquartered here in Golden. Home Advisor recently made some big news by announcing a pretty bold new project anchoring the hub development up in Rhino. Chris recently worked for Nutrisystem.com and Match.com. Bob Hotman, second from the last there, is a founding partner and the CEO of EKS&H. EK is one of the largest professional service firms based in the Western U.S. They've got 650 employees in Boulder, Fort Collins, Denver, San Francisco, and recently they were named the #1 spot in the Denver Business Journal's list of CPA firms here in Denver. Final panelist, Mark Bowen, Senior Vice President, DCT Industrial Trust. DCT is a leading real estate investment firm that's focused on distribution facilities, primarily focused in high-volume markets. Mark handles all components: acquisition, asset management, disposition, everything basically in the Denver and Phoenix areas. Gentlemen, welcome. Have a seat. To the audience, we are going to be doing a Q&A subsequent to my questions for the panel, so feel free to start thinking of those now. Ned, I'd like to start with you. Unico has been really active in the past couple of years, and so I'm curious, from looking at Denver, what have been the primary drivers for your investment strategy?
We look for markets where people want to be, and we look for markets where people are moving without jobs, because we feel like any market where someone's moving without a job, jobs are going to follow, so that's kind of a leading indicator. So we started buying here really because of the lifestyle and just the demographic shift. We also are believers in urbanization and have focused primarily on downtown locations where people want to be.
Great. There's several people in the audience who are not from Denver, a lot of national folks. They've probably seen a lot of cranes going on throughout downtown and just the greater metro area. So to that point, Adam, what's your perspective on the growing development pipeline in the multifamily sector here?
It's a good question. It's a question that's come up quite often, especially from investors that are coming in from out of town trying to understand it. And it really needs to be looked at from a micro market perspective, and with that sort of lens. On one hand, delivering 10,000 units a year, year over year, in and around the urban core, that's a big dump of supply. And on the other hand, I think there's a lot of suburban submarkets in Denver that are undersupplied and are having a hard time getting stuff built. And so, from that perspective, it really is a tale of two cities. And some of the conversation very recently has been around, all right, is it a growing pipeline or is it a stalling pipeline? Is it slowing? What's going to be kind of the next phase? And if your business plan in Rhino is to build, stabilize, and get out in 18 to 24 months with all the other stuff coming online, it might be a little slower than you had hoped, but the demand is definitely there, and if you have patient capital and can weather that kind of thing, I think it would be just fine.
Well, I think based on some of Tom's points in his slideshow, the demand clearly is there from population growth. So to that point, Chris, with some of the demographics occurring here in Denver, what is it that the Metro Denver area provides you, your CEO of the company, that perhaps other markets don't?
Well, a couple things. I mean, first and foremost, it's a lot easier to run an internet company in a city like Denver than it is in the Valley. I think all of technology has sort of become commoditized, so it's a lot easier to get good talent, people who are looking for an alternate lifestyle in terms of mountains and outdoor activities, and not having to pay the price of a San Francisco or a New York or an LA. So for us, it's a great place to be. I can get great talent at a good price, and I can, in return, provide a great lifestyle for a millennial or someone who wants to be here. And so for us, Denver is great. I grew up went to school in Austin. I think we're kind of the next Austin in the sense that you've got a really cool city that's very appealing to millennials, and I think you see the tech trends are growing here. And so I think this is going to be one of those what I call default cities. You're not in San Francisco, you're not in New York, you're not in LA. Well, where do you want to be? Do you want to be Austin, Portland? I think Denver has now risen to the top, and so it's a great place for us. We're finding great talent, and I think it's a place that all sort of tech companies should really think about.
All right. Spread the word to your tech company friends.
I will.
Mark, continuing on the demographic trend, how are some of these changes going on in our market impacting the industrial world?
Sure. So the industrial world, I mean, it was talked about in the opening remarks. Denver's always been kind of known as that sleepy little town. Industrial was mainly regionally focused. Not a lot happened. Since the population growth and so many new industries come here, obviously there's been a huge dynamic shift in the distribution market. You got to have needs for storing goods and services and distributing everything to supply all the new home building, all the new people living here, all the new goods and services that are need, retail, which I'm sure we'll get to later. Industrial is also shifting a little bit as we overlap with retail now. As e-commerce comes into play, more things are coming directly out of distribution centers and directly into homes, and cutting out a little bit of the retail that we normally distributed to. And so Denver has evolved as the economy has evolved to not just be that sleepy regional city anymore. We're more focused all the way up and down from Canada to Mexico and from Chicago to LA.
Okay. We saw most recently Denver's employment numbers came out again, and we are one of the top in terms of in the country with low unemployment rates. And there's a lot of benefit that comes from that, clearly. But when you look at full employment, that brings some hurdles. And so, Bob, from your perspective, how is that trend impacting your ability to hire and grow in this market?
Well, I'd like to say it doesn't impact, Peter, but it does impact if you're hiring experienced people. We are a service business. Everything we do is about people. So for us, acquiring the right people and retaining the right people is how we focus on everything. So even when we look at our real estate needs, it has to do with what we need to, how we acquire people and how we retain those people. So we look at the growth out there from a market perspective. If we're trying to acquire and retain high-level talent, we're able to do that. But most of our people actually are right out of school. And what we've had to do is we now recruit from over 15 universities around the country. And we've expanded way beyond Colorado to do that because we can bring people to Colorado because as Chris indicated, people do want to come to Colorado. So we're finding that people from Texas and Utah will move here. So.
Adam, you were talking a little bit ago about just the general growing supply and the increasing pipeline of the multifamily product here in the market. Aside from just the increasing supply on its own, what other headwinds do you see facing your sector in this market?
Yeah, I think there are, multifamily's been on a tear. It's been very strong in Denver. And it always, the question's always when are the challenges coming? What's the horizon like, et cetera? And there's probably a couple that are challenges closer than others right now. Capitalization is one. I think we're already seeing strong headwinds in getting new construction deals capitalized. And the other might be rent growth, and that's a bit of a tricky one. Rent growth, we're not bearish on it whatsoever, but it's kind of it can be a tricky one to figure out. There's wage growth and rent growth in Denver do not go hand in hand, and they have not for quite some time. So in that statement is somewhat of a perceived ceiling. But on the other hand, the dynamics of supply and demand is a nearly immovable force, and the demand is clearly here. People still want to be here. And so there's opportunity, we think, for continued rent growth, albeit maybe at a little slower pace.
Where do you see the differences happening geographically? Is there one area that can do no wrong and other areas are struggling to increase their values?
Well, you'd love to be able to say that something's clearly an area that you can do no wrong, but there is still a good gap in rents for a lot of the suburban markets between A and B product, or it's just lower than what's happening in the downtown core, especially Lodo, Rhino, et cetera. Okay. So there's still, if you look at the rent difference between something in the Highlands and something in Highland Ranch, there's still opportunity there.
Okay. Ned, I want to come back to office for a second. Barry had mentioned in his introduction about, clearly the Denver market's undergoing a slowdown in the energy sector. So I'm curious from your perspective, and again, because you do have product in all major submarkets in Denver, how do you see that energy slowdown impacting your investment?
From my perspective, I think the energy slowdown is finite in nature. It's not going to continue perpetually, and we have to work our way through the sublease space and the new vacancy coming on the market. But eventually, that sector will come back. So on the acquisition side, I tend to be fairly bullish on the prospects over a longer term investment horizon in submarkets and micro markets that are more impacted by that. Also, acknowledge that there is less capital chasing those deals. So, we've made some decisions to hold on to properties that are a little bit more impacted by those. So we're holding on to investments and also looking for opportunities because I think we will work our way through it. It's just going to take some time.
What's the driver behind Platt Street?
For us, Platt Street, it's about lifestyle, I think. I think that we like that location. We think it's a very unique location in the city that offers a little bit of a community feel to it. It's connects the Highlands to downtown. And our acquisition there was really based on just the quality of the buildings and the unique offering it had for tenants and people that wanted maybe a little bit different feel than a true urban experience. And then our decision to develop there is really related to that, and that we think there's a lot of demand for that market. When we look at developments, we look at creating a place that people will want to be and be excited about going to work, and also developments that are going to enhance and grow the experience in the community and the neighborhood they exist. So our development hopefully will add some energy and vibrancy to what we think is a super neat part of Denver.
Good. Mark, you mentioned a little bit earlier about the regional nature of how Denver used to be. And, bread and butter was a phrase I think you had mentioned to me when we were talking before this event. Clearly, you see that changing. And I think based on some of your recent moves with DCT, you're altering your investment strategy. So can you talk a little bit about how you're starting to, capture more of a increasing demand from new users?
Sure. Well, the industrial world is... you see a lot of, cranes out there, a lot of development. We own about 2 million square feet here in Denver, and I'm a landlord, so this next statement's going to sound a little funny. We're 100% occupied. Rents are going up. Everything's great, right? Well, as the economy grows and expands, we have tenants, users that need to get bigger. They need more space and nowhere to go. So thus development starts. Quite frankly, what we witnessed, anytime this market gets below like a 7% vacancy rate, it really needs new supply. It's in the 3.5% vacancy rate right now. Some of our tenants, we lost other markets because they had nowhere to go. They couldn't even go to our competitors. So our dynamic shift, a lot of others as well, is looking for quality locations to start new development. We have a couple getting ready to start as well. You've seen several going, but quite frankly, you always worry as a developer of being overbuilt. Quite frankly, it's not coming fast enough right now to satisfy the demand for the users that want to come to this market, that want to be able to supply the populace, not only in Denver and Colorado, but Utah, up to Wyoming, to Kansas City. And talking about the bread and butter comment, that's not how this market used to be. We used to be 25,000 to 100,000 square foot sort of users. Now that's still our bread and butter, that's still our mainstay, but we're now seeing 400, 500,000. It was just announced a couple weeks ago, Walmart's coming. It looks like they're gonna build a 1.2 million square feet in 2 buildings. So you're seeing those larger users shift. That's a huge dynamic shift, and we all know about Amazon. That's coming. It's already come here in 1 building. They took down 450,000 feet. More of that's gonna come as I mentioned before, e-commerce comes. They want to get in the market. They want to be able to get closer to distribute to the folks that need their product.
Okay. Well, I want to focus, Chris and Bob, just as the occupiers, maybe dive a little bit deeper for a couple minutes with both of you. Chris, with the new development at Hub, how do you envision building out that space? How is it going to look, feel functionally very different from what you have today? Is there anything kind of cutting edge about it?
I don't know if it'll look that much different per se than what we're doing. I think my goal is always to make sure my workforce feels like the space is a place they want to be in, they can feel good. Frankly, there's sort of this indistinguishable line between work life and sort of non-work life. And so we're seeing interesting trends in how our workforce wants to be in the building. So I'm watching everyone go to stand-up desks that are 5 feet wide, which is an unusual trend, and the trend started basically by them. It's not me saying you should do this, it's them saying this is what I want. So I find myself responding to what they're wanting, whether that's more informal place to sit and hang out. And so I think the space that we've got in Hub really reflects both the worker I want to attract and the worker that I want to stay with us. And it's a competitive advantage because we pay well and we're growing and we've got a great brand, but you have to be able to give more for the new workforce. And so in our case, it's a really cool space that reflects how they want to work, how they want to socialize, what they want to do after work, so that I sort of create that work, life, meshing that they're looking for. And so I don't think it'll be necessarily that much different, but I will certainly say what we had in Golden was a combination of sort of an internet company with a sales and operations. We'll leave our sales and operations there. They have a different set of needs, and this will be more purely reflective of what that internet culture is, and frankly, what a millennial workforce is looking for. So it's a really great fit for us.
Okay. Well, Bob, to the Chris's point about standing desks and just the general trend of hoteling, flexible footprints, et cetera, what has that done to impact your company culture, along with any recruiting efforts of this generation or the next?
So you have to understand our business, Peter, and we have 4 generations within our organization at any one time. So we still have the baby boomers, and we're not quite gone yet. But we're getting closer, I know that. And then we have our Gen Xers, and then the Gen Ys, and we don't call them the next gen, we actually call them the Gen Zs, which we're actually hiring right now. And every one of them has a very different need, which is really fascinating. And so when we start looking at space, and we actually just signed a lease, thanks to JLL, on the tech center for about 150,000 square feet. And I joke because one of the things I said I'm going to do is put the baby boomers on one floor and the Gen Xers on one floor. That seems a little bit easier, so it's kind of like your salespeople, Chris, where you can leave them a little different because their needs are a little different. So we're finding that the key is to have space that's incredibly flexible, that can work with whatever group we have. And so we do believe that let's take for instance the millennials, and we know that millennials like the collaborative, really open space. I'm going to tell you, the Gen Zers came out of a recession generation, and they're a little tighter to the vest, and they're not willing to be quite as collaborative as the millennials. So how are we going to be able to deal with that? So our key is to be very flexible on the space so we can move it as necessary and try to accommodate as many generations as we can. So that's kind of where we go. And part of where we focus in our world, a lot of times you hear, you hotel. That works great if people are out of the office. You can hotel, but if people are in the office, you can't hotel. And over half of our people are in the office every day. So we have a fairly good number of people that will office share or space share, and we have a big number that won't. So flexibility is the key.
To the flexibility theme, both of you, unique might not be the right word, but you're in different markets within this metro, Southeast, Boulder, downtown, West, downtown. How does being in multiple markets or having a foot in each pool work for you with your company? It's different needs, sales and operations in one. Do each of those markets serve different purposes for you?
I mean, for us, being downtown is it's important because we did get poached a little bit. We were basically folks saying, hey, you want to be a developer or you want to be a product person, we've already got a downtown location. So for us, a lot of that sort of core internet talent is much more downtown, whereas our sales and ops was fine. It's sort of centered around where we are in Golden. So I think from a competitive perspective and from making sure we both can attract and retain the best talent, being in Rhino, being in the cool area, being in the area where either new talent coming in, it would be appealing, or frankly, our core internet group is already sort of centered around downtown. We were pulling them out to Golden. It was important for us from a competitive perspective of bringing in new talent, keeping the talent we have, and I think it's an advantage if you can be down there in those areas that reflect what whether it's millennial or younger is looking for.
What about you, Bob?
So some history so people understand where we're at. We have traditionally been a suburban firm. We're out in the tech center. We're in the north end of the tech center. We're going to stay in the north end of the tech center. We have about 125,000 feet out there today. We signed a lease for 150,000 in the tech center. But we also have about 7 to 10 years ago, we expanded into Fort Collins, and we also expanded into Boulder, and it was more so people could live in those communities than where the client needs were. So we were able to let people kind of to focus in on those areas. When we take a little vote of our staff, who wants to be downtown, who wants to be in the tech center, pretty much anybody under about 28 wants to be downtown, and anybody over 28 wants to be in the suburbs because they want to raise a family, they want to have a home, they don't necessarily want to commute. And as we like to say, we could put all those 28 and unders downtown, but they need a little bit of adult supervision. So what we've kind of done from our perspective is we do have a big footprint in the tech center, and we're going to continue that footprint. We're going to continue to grow on that. However, we have recently, the beginning of this year, we took about 6,000 feet in the Chamber building, which is a great building, easy in, easy out for our people, where we're starting to build a downtown presence also. So we'll have a dual capacity. The hardest part for us is who you decide is going to be where, and it pretty much becomes somewhat self-selective because in our world, you don't necessarily have a group of people that you can move because the interaction is so great. So we have a tendency for our downtown practice to be much more oriented to those people that are in and out of the office a lot. And so it's much more of that office sharing, office hoteling type of thing. So
when you guys were looking at the Southeast market, I think one of the interesting contrasts, Home Advisor went to anchoring new development in Rhino, kind of a little bit more of a cutting edge district. In the North Tech Center, a lot of recent large transactions have been occurring more in perhaps light rail centered properties, new construction down there, but you didn't do really either of those. So I'm curious, when you were going through that whole process, what drivers were influencing the ability to be on the train or the ability to be in something new?
So there's not any one factor that's going to decide where we wanted to go. We started the process, 2 years ago, because we knew if we're going to look at new construction, we needed plenty of lead time for us to build out the space and have that. So we started the process, and we start looking at new construction, and at the end of the day, we're accountants. And when you see the price of new construction, and I got my partners off the ground as to what that was going to cost, they said, well, what else is out there? So new construction is very expensive, and we were willing to go with that. We were going to have to reformulate what we look like in order to do that. So we went out in the market, and I can tell you that there's not a lot of 150,000 square foot spaces available in any one place out there. So we took a look at everything. You know, knock on wood, we were very fortunate, thanks to Barry and his team with Mike Rooks and Dan McGowan. We were able to get a heck of a deal on a very long-term sublease, which is about $15 to $20 cheaper than new construction. Multiply that out times 150,000 feet, multiply that out times 10 years, you have a lot of money. And so we felt we didn't need to be next to light rail for a couple of reasons. One is most of our people don't live on light rail, so therefore to get to a light rail office, it was going to be difficult. And once they get in the car, they're not likely to end up getting on the light rail to come down to be there. So that was the one thing. And quite truthfully, if light rail does become important, we'll buy a van and a driver, and we'll save about $1 million a year by doing that. So that's we think light rail is nothing more than a transportation option, and that's the way. That's why light rail. And construction, for us, it was about location, because most of our people really still do live in the South. So we need to make sure we accommodate that. We do want a Denver address, so that really narrowed down basically Bellevue North that we could actually focus in on. So those are the two biggest factors. And then quality of the building ultimately became the three, that and cost became the three big things that we looked at: location, quality of the building, and cost.
Okay. Well, coming back to the landlord's perspective, but still staying kind of within this multiple location theme, as I mentioned before, you've got offices northwest, CBD, southeast, suburban. Amongst those different areas and within them themselves, are you seeing big differences in tenant demand and deal flow?
Yeah, and we're in almost all the primary markets, and we're seeing very different velocity. We still see very, very strong velocity in Lodo and the Union Station part of town. On the kind of east side or uptown, we're seeing a little slower velocity, largely the result of oil and gas and some give backs and softness over there. It's been interesting though in the suburbs. Velocity is slower, but it's not non-existent, and so we're seeing some kind of interesting opportunities in the southeast from my perspective, where I'm looking at buying opportunities. Capital is not really looking at the southeast or any suburban markets. I mean, it's very, very thin when you go to sell, and prices are low or much lower than probably you would expect, and it doesn't seem to match up to me with the fundamentals of those markets. I tend to agree that or suburban markets aren't going away. They're changing and becoming a little bit of a different dynamic, but they're certainly not going away. And capital is kind of pricing them in a way that as if they were going to go away. So that's been kind of an interesting dichotomy that we've noticed. Mm-hmm. We're selling a building, Ryder Square, which had very good interest. We just sold Centerpoint 1 and 2, which was super thin. Pricing came in well below our expectations and our own value, and these two assets were trading at the same time. So it's kind of interesting to just see, in very real terms, how different these two markets are.
Yeah. Well, Mark, you mentioned earlier, Walmart, Amazon, some of the other big names happening out closer to the airport. It seems like a lot of the big news in industrial is coming out of that area. But from DCT and your investments, are you targeting anywhere else in this market? Do you see opportunities elsewhere in other geographies?
Yeah, part of it was mentioned in the opening remarks. There's a couple things that have happened in the industrial world. Everyone here probably knows most industrial's kind of thrown out in the Northeast, people don't want industrial buildings close to residential. That dynamic's changed a little bit with the closing of Stapleton and the opening of DIA. There became actually a new infill market that didn't exist before, and that's the Stapleton area, right as you go along I-70, that have put up several new buildings that have been extremely successful. But still, the primary industrial submarket is the Northeast market, and as you see a lot of the new buildings going along Pena, the Pioneer deal. You see that's where Walmart's going to be just south of DIA when and if they start building, and that whole gateway area, as well as Majestic, who's a very large private landowner just bought another 500 acres to keep moving. So it's moving east along I-70, but you also, it is, I mean, I don't know if this is how the theme's supposed to work for us. It's a tale of two cities. We own some product in Central, which is Pecos and 25, and there's very little supply there, but there's intense demand of users who want to be there, to be close to downtown, to be close to Golden, to be close to the arterials of 25 and 70 to go south. And I think you're going to see a huge demand for that as this I-70 project kicks off and the widening starts. As truckers don't like to drive farther, and they certainly don't like to drive on difficult routes. So that's going to be an interesting dynamic to watch going forward, of how that affects the whole distribution market for Denver and the Northeast, because most of those distributors are coming right back into 25 and either going south or north. But you'll see, if you drive, most of the new construction is in the Northeast, and that's simply a function of cost of land. Most land in closer is for higher and better use, office, retail, residential. So that just simply is where it works. And then the second reason is just pure footprint. To get the size buildings that the market demands now, you have to go out where there's land availability to buy some of this and develop it.
Okay. Adam, question for you. You know, every apartment building these days, there's an arms race going on in amenities. You know, rooftop decks, bars, great pools, et cetera. What are some of the next IT amenities you're seeing come out in the multifamily world?
IT amenities, it's a good question. It seems to come up every cycle. I rarely like the answers that people tend to give. And I guess where people will go wrong, I'll start from that perspective, is, you know, they see something trending and they're trying to check a box, and they'll say, all right, we want one of those in our community. And you know, I've seen bike shops and great bike storage areas in areas that in communities that had no reason to have a bike shop. They just wanted it, and it was not anywhere near a bikeable area, and it just became wasted space and kind of a wasted opportunity. And the whole IT amenity, that's a good descriptor, because it sort of has a gimmicky connotation, and some of that stuff is a little bit gimmicky. And you know, I don't know. I've seen ultra luxury dog spas. I've seen bowling alleys like crammed into small little spaces, and there's a value there, but it's probably a marketing value, not an amenity. You know, that's where it should go in your budget. Those differentiators jump out at residents, and or prospective residents rather. So that probably has some leasing help, but you know, our focus is right now, we focus on anything that enhances the use of outdoor space. You know, I'll show up to a community we're looking at, and there will be a grill sitting on a pole and a picnic table by it. And that's perfect, because that's a blank canvas to just design something easy, inexpensive, but very usable. Anything that gets somebody out of their apartment and enjoying the outdoor space. One, that's what people in Colorado demand, but two, it sort of enhances their experience there, where it's more of a home and not just an apartment building. The other thing that we're focused on is fitness centers. We buy a lot of 90s and 2000 vintage stuff, and in that era, fitness centers were often just an afterthought. They were crammed in the back corner, almost like a select service hotel type of a place. And so we'll spend a lot of time and money reconfiguring our clubhouse spaces, or in some instances expanding our clubhouse spaces to accommodate a reimagined fitness amenity. It's been very well received, and most important to me, it gets used, so it doesn't feel super gimmicky.
Yeah.
And we're not trying to be pioneering and figure out the next best thing and be ahead of the curve that way. We want what's being used now and what do people demand.
Well, Ned, if you want to be pioneering, you can put a dog spa in on Platt Street. You know?
We are putting a bowling alley in
That's right,
the Denver Club, so.
For you in the audience, we've taken a pretty macro level overview, just of different market categories here on the panel, and I thought that we'd maybe now, the guys up here have been kind enough to endure my questions, and I'm sure many of you in the audience are smarter and way more eloquent than me. So if anybody has any questions, do feel free to raise your hand, and I don't know if there's going to be microphones that are traveling around, or just shout it out. One in the corner. Yeah, Mitch.
Yeah, hi, this question is for Mark Bowen. Mark, in the past upswing markets, pre-2008, Denver industrial has truly been a tale of two cities. Pretty active on one side of the street, not so active on the other side of the street. In this upswing, in this particular marketplace, it seems like both sides of the streets are doing great, all product types, all different markets. It seems like we finally made it to the big leagues. Two questions. Do you think, we'll definitely have some ups and downs over the time, but do you think with Amazon, Walmart, Best Buy, all those other groups moving here and playing, do you think we're finally made it into the big leagues here in our Denver market? You've worked across the country as well, so do you think we will, and if we will, why?
Yeah, so I worked in the Seattle and the Phoenix markets, and let's just put an example to that. I mean, we are enjoying a extremely good market right now, and one would think, well, when's the other shoe going to drop? What I've seen in those other markets, which is yet to come to Denver, exactly what you're talking about, and what I alluded to here is, I've been to several meetings with Amazon and what their strategy is. And they want it when you order it in your house, they're trying to get it that day. Phoenix is a perfect example, in Seattle, where they're headquartered, is the same example. Is they look at population basis and what the young people are doing, because that's who's ordering from them. And they look, where's it going to grow in the country? And it's typically been the coast, but they see Denver pop up on this map, and they see more and more people coming here. Just like Phoenix, you have 80,000 people moving there a year. And the only way they can do that is they put together what's called a hub and spoke system, a very large distribution center surrounded by smaller distributors. So what gives me a great positive outlook on Denver is it's already good because it's diverse, and e-commerce is only just starting to come here. Amazon just took their first building down. There's more to come. They're all fighting. Walmart's trying to catch up with them in this market. They're all racing to Denver to be able to distribute to this growing young population. So to answer your question is, everyone asked, I was on a panel a couple days ago, what inning do you think we are in the game, in a baseball analogy, as far as industrial is? And I said, well, I think it's the 7th inning because it's been so good and it's been going up. It just can't keep staying this good. The other shoe's got to drop. But quite frankly, it's maybe 7th inning, but I think we're going into extra innings because the next wave, the next thing is only just now starting to come here, and we're already enjoying a very good market now.
Any other questions? Yes.
Are you guys seeing a substantial increase in development costs, the city costs, the cost of capital, and what do you think that effect will be if you are seeing it on the pipeline that we've all been talking about?
You want to take that one, Ned?
Sure. The question was, are you seeing substantial increase in costs, and what's the impact of that? We're seeing, and we've been seeing, I think, a run up in pricing for probably 2 to 3 years, really, and maybe even seeing a little bit of, they're super high, but maybe a little bit of a tapering on how much they're increasing, but also we're having problems on just simply availability. It's not just pricing, does a contractor, does a GC even want to bid the business, or do they even have a team that's available when you need to do your project? So pricing is high, getting things through the approval process takes a lot longer, and getting a team, subs, bidding in a competitive environment is very tough. So it's not a great time to be doing development from that perspective.
Okay. Anybody else? Yes.
Sure.
Denver really needs a better central design center, and it's one area that has not been the focus, really, of the market. And I'm curious to hear from you, as well as some of the other multifamily housing groups. We looked at having, 2570 was the '70 and that kind of went away. Is there anything in the works from any of you guys on a new design center?
I think this is above my pay grade. I'm not sure exactly what you're asking. You know, I'll just give you our perspective. Being close to light rail, you know, having the ability for people to come out of the Highlands and bike over there, we may be imperfect, but it's absolutely what our workforce wants. And just, you know, one anecdotal example, my sister's in Brooklyn. She came out here and she was surprised at just how cool and how interesting Denver was, how interesting Rhino is. And I think if you look, I ran, you know, was at Match in Dallas. I've been to different places. We have an office in Times Square. Denver has a really, really great combination of elements that you don't see. I mean, it's relatively affordable relative to San Francisco, whatever else. You've got pretty good music, you've got good food, you've got the mountains. Like I said, I went to school in Austin. I think this is a better Austin in many ways. So I can't answer your other question because I'm not sure exactly what you're asking, but I can tell you that I think for our folks and for people that we're trying to recruit in, and we, you know, bring people in from the West and East Coast, they're very surprised at what a great city this is. They're very surprised at what it has to offer, and I think that's just going to grow the way Austin did. I mean, I watched Austin take off from sort of sleepy to what it is today, and I think Denver has that potential, you know, and a lot more, frankly. And I think we can steal from New York and from San Francisco and from LA. So someone else can maybe answer her
Well, I think
more
I mean,
specific question.
from the interest of time, I know we've got some stuff to get through, and I want to be conscious of everybody in the audience's time. So with that, we're going to wrap it up. But I do want to thank everybody here on the panel: Mark, Bob, Adam, Chris, Ned. Thank you guys very much for taking the time this morning. Appreciate it. Yeah, talk to you in a little bit. Get it off either way you want.